Good morning, everyone, and welcome to this video. This video will be talking about adjusting entries. Um, these adjusting entries are is just one of the many topics in accounting that students find it very difficult. So especially if they are not well versed with original journal entries, so it will be very hard for them, or they find it very difficult. So in this video, I am going to discuss this one in detail, and I will give you some examples and we'll tackle them step by step. So let us try to define what are adjusting entries. Adjusting entries are considered as journal entries at the end, or actually before the end, before closing the books of accounting, because its purpose is to allocate the income and expenses to their proper accounting periods. So most of these expenses and income are sometimes a mixture of the future accounting year and the present. So we have to allocate this income and expenses to their proper accounting period. Now, what are the reasons for allocating them? Is there any problem? But why it is not okay that these accounts will be mixed with the present accounting year and the future accounting year? So these are some of the two reasons why we have to allocate. There is really a need to separate the income and expenses of the current year to the from the next year's income and expenses. Number one, we have the matching principle. So matching principle in accounting states that income, all the all the expenses that will be reported in the current year should match the income that is earned during the year. So income also that are supposed to be reported during the year should are those income only that are earned during the current year. So with the expenses. So all those income and expenses that are not earned or incurred during this current year should be separated. And that is the reason for adjusting entries. So number two is to identify the income that are for the next year's accounting period and also the expenses of the next accounting period. To evade from overstating and understating the income and expenses. So later on, you will understand the application, you will see the application of these theories. So what are some of the accounts that are being adjusted at the end? Actually, we have five. So we have five. We have the accrued income, we have the accrued expenses, we have also some prepayments, unearned income, and depreciation. So in this video, we are going to tackle one adjusting entry. We are going to give you an example. We are going to discuss it in detail so that you will understand how we got the adjusting entry. So what are the past knowledge? What is supposed to be the knowledge that you have before you tackle adjusting entry? First, we have to master the original journal entry. So if you think that you are not really confident in yourself in the discussion and the creation in the production of the original journal entries, I have a lot of videos that are shown in YouTube that will teach you how to prepare 100% error-free journal entries. So we are going to proceed now to the first adjusting entry that we're going to discuss. Okay, let us move now to our example. Example of an accrued revenue is accrued interest income or accrued interest. The Say for example, the company received a promissory note, a 60-day promissory note for 6,000 on December 15, 2019. The ending period is December 31, 2019. So kindly list down all the information that will be very beneficial to your computation of the interest income. First, you have the principal 6,000, the interest rate of 20%. You have there the date of receipt of the promissory note, December 15, 2019, and the ending period 2000, December 31, 2019. So first step, use the formula in mathematics which will give us the interest for the year, for that particular period I mean, but you're going to use of course the yearly, because if you say 20%, that is good for the yearly rate. So the formula will be PRT, principal times rate times time. So the principal is 6,000, the rate is 20%, the time is 60 days over 360 days. So upon computation, you have there 6,000 multiplied by 20% times 60 over 60. The result is 200. Okay? That is the yearly rate. That is the rate for 60 days. But if you try to look the date since the promissory note was received to the end of the period from December 15 to December 31, there are only 17 days. Okay? So the number 2 computation is 17 days over 360 days multiplied by 200. That is the rate for 60 days. You got there 9.44. So that is the interest income from December 15 to December 31, 2019. Okay? So for the adjusting entry, you're going to set up the asset. So the asset there will either be accrued interest income or you can use interest receivable. They're all the same. And the credit will be interest income. So our adjusting entry for this example is debit interest receivable or accrued interest income, credit interest income. So I hope that you can if you cannot still understand, you may go back to the discussion and then try to ask questions if there is something that really confuse you. So you may comment on the comment section, and please try to ask me if you cannot understand any detail of that. So later on in the next video, we are going to present to you the other adjusting entry. Please subscribe to this channel, and I hope for more videos in adjusting entry. And you may look also to the other videos that I have, like the journal entries, so that you will understand more on adjusting entry. So they are all related. If you are very good in your original journal entry, there is no reason why you cannot get adjusting entry. So see you around. Thank you so much.